You can't get away from the fact that all investing involves a degree of risk. The value of your investments can go down as well as up, and you may get less back than you invested. In some cases, you could even lose your entire stake. Risk is often confused with volatility, but they are in fact two different things. Volatility is the measurement of how much a particular security's value can fluctuate over a period of time. Equities, in particular, are subject to periods of volatility, which can be very extreme. High volatility might keep you awake at night, but it shouldn't be mistaken for risk. Risk is something much more personal to you and your portfolio. For example, the risk of not having enough money to last your lifespan or to fund a specific goal. A common type of investment risk is concentration risk, the risk that your portfolio is too concentrated in one area or asset class. There's also credit risk, the danger that a corporation or even a government will default on a bond. Then there's liquidity risk, where your money is tied up in an investment that's difficult to access and release cash when you need to. This can be a real concern for those who invest directly in property. Some risks are more avoidable than others. For example, you can avoid concentration risk by having a diversified portfolio, spreading your investments across asset classes and geographical markets, for example. But one type of risk that you can't diversify away is systematic risk, also called market risk. Market risk is the possibility that you'll experience losses as a result of factors that affect the overall performance of the financial markets. In general, markets reward investors for market risk. The more risk you take, the greater the potential reward you can expect in the long term. In practice, though, accepting market risk is far harder than it sounds. Although you can expect higher returns in the long term, staying invested when market risks are on the rise means you could have to endure market fluctuations that can test the resolve of even the calmest investor. That's why, as an investor, you'll have to think very carefully about your need, willingness, and ability to take risk. In many cases, you will need to compromise. Finally, don't forget the risk posed by inflation. Inflation will erode the real value of your investments and hence your future spending power. So not investing enough is a risk, and so is having an investment strategy that is too cautious. Yes, that's right. Not taking enough risk is itself a risk.